Welcome, I'm Ernie Goss, Professor of Economics here at Creighton University in beautiful downtown Omaha, Nebraska. And here I am on the first business day of the month, as I'm usually here the first business day of the month, reporting on our survey results for the month of April in this case. Now these are businesses located in the 9 Mid-America states, the Mid-American Survey of Business Conditions. And these are the states stretching from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south. And from these 9 states, we get a leading economic indicator for the region. Now, what's it looking like? Well, the number, it ranges between 0 and 100. 50 is growth neutral, so anything above 50 is growth positive. Well, the number for the month of April, sorry folks, wasn't that good, but still above growth neutral. It moved from 51.4, which is, can I call that tepid? Not good. Anyways, but it's better. It's above 50, so that is good. It moved to 52.7, still in the what I'll call tepid growth range. So looking ahead for the next 3 to 6 months, we're going to see growth, but growth at a pretty slow pace, but positive. Now, when we ask about companies, when we ask them about applicants to their company, in other words, are you getting a lot of applicants? Are you getting more? You got more openings than you have applicants. About 29.1% reported that they have shortages of qualified workers. Now that's up a bit, so we're starting to see a little labor shortages, depending, of course, on the area of the region and the occupations we're talking about. Now here I'm going to bring up the chart since October of 2013 to our current April of 2015. And you see there in red, you see the U.S., and in Creighton blue there you'll see the Mid-America, and you see not good, kind of limping along. You see both numbers are sort of moving downward, trending downward, but still above growth neutral, still positive. What else came out of our survey for the month of April? Lower inflationary pressures. Now that's been pretty much what we've been seeing for some time now. Our inflation gauge moved from 57.7 to 55.5. I'll call that not deflation, I'll call that disinflation, meaning the inflation rate is coming down, at least at the wholesale level. We ask about sales price growth, how much they expect prices for the products they sell to grow by in the next year. 1.6%. That's still below the Fed's target rate. Of course, we'd like to see that pick up a bit. We looked at confidence. We asked about confidence. It moved from 55.7 to 61.5. So business survey participants are getting a little more confident. Things are looking, but it's a confidence that's just not matched by a lot of growth, as I was saying. Now the export orders were down. Of course, with a strong dollar, that makes U.S. goods less competitive abroad. 56.4 moved from 56.4 to 53.5, down. So it's still above growth neutral though. Imports moved from 53.5 to 46.8. So the trade numbers are not what we'd like to see. So all in all, it was a pretty good report. Like to see better, but the national number, which will come out later on this morning, is probably going to be much like our regional number. Now, what do you need to watch out for in the next month? What are the factors you need to keep an eye on that could change any of these numbers, the relevance of any of these numbers? Jobs report comes out 1 week from today. That's going to be a pretty important number, comes out from Bureau of Labor Statistics. Look for a number, I think it's going to be pretty good, meaning about 180, 200,000 jobs. That's in the okay, actually pretty good. How about pretty good, is that accurate enough? And look for the wage number though. If that wage number, hourly wages begin growing at an accelerated pace, then the Fed's going to be raising rates. I don't think that's going to happen, but that's something to keep an eye on. Look at the CPI, which comes out May the 22nd. That number has been ticking upward because of rents. Rental values have been growing. Rents have been growing a bit faster than we'd like to see. But that said, overall the CPI has been in a pretty good range. If it should tick up significantly, though, that would be a risk factor. Risk in terms of the Fed. The Fed would have to begin raising rates. Right now, the Fed's not going to raise rates any time, at least right now, until perhaps the fall of 2015. Now, keep an eye on the 10-year Treasury. Believe it or not, that rate has gone above, our yield as we call it, has gone above 2%. Now, what is that telling us? Well, one of two things. One, perhaps a little bit higher inflation. Of course, that is tacked on to the rate. Secondly, risk factors. When risk are reduced, that yield goes higher. So probably a little of both those factors. Keep an eye on it. If it moves significantly higher, that's a huge risk factor, and something to keep an eye on. And in terms of risk, that's a huge risk factor. Of course, if that yield begins increasing significantly, that'll increase mortgage rates, and of course that's a real issue because the housing sector, even while it has been growing, is just not back to where we'd like to see it. That was new construction, that is. Keep an eye on the Greeks in terms of a Greek default of their sovereign debt. They keep threatening. They may in fact follow through on that by defaulting on some of that debt, whether it may be to the IMF, the International Monetary Fund, but it could be to other banks in other parts of the ECB, the European, I should say in the Eurozone, sorry about that. So keep an eye on that. Another factor that's always a big part of this part of the nation, this part of the economy, is the value of the dollar. When the value of the dollar strengthens, that makes U.S. goods less competitively priced abroad, brings down agricultural prices, and that's important in this part of the country. Keep an eye on the dollar. I don't think it's going to strengthen significantly. In fact, I think it could just move sideways and could even weaken a bit. And that's pretty good because another way it affects the economy in the U.S. and this region is when those companies they have earnings abroad. When they bring them home and convert them to dollars, that reduces them with a strong dollar. So that's something to keep an eye on. Again, when I talk about the risk factors, I think the Greek bond default is the most likely, and that's something to obviously keep an eye on. So that's it for the month. So to characterize our monthly report for the Mid-America region for the 9 states, how's this? Okay. It was okay. Like to see it stronger. I think the U.S. number, when it comes out later on this morning, is also going to be okay. So until we meet again here on June the 1st, first business day of the month of June, when I'll report on our May survey findings, may your economic cup runneth over.